In this market turnaround, small caps may be the first to see the biggest jump. Today, MarketBeat's Chris Marcotte shares 3 small cap stocks that are priced really cheap right now when you look at their earnings. Chris, I'm excited to dive into this topic and the 3 names that you have for us today. A couple of them are completely unfamiliar for some people, but there's one really big name that might surprise some viewers. I'm excited to dive into that one too. But let's start out with a look at why small caps. What's the chatter around the small cap market right now?
The chatter around small caps right now is that this is a sector that's been just, you could call it dead money over the last few years. There's small companies. It doesn't mean they're not generating revenue. It doesn't mean even that they're not generating positive earnings. It just means that they're smaller companies. When you see a market where interest rates are higher and you have other headwinds in the market, generally speaking, investors are going to go with some of the larger cap names and they're going to avoid some of the names in this sector. However, there's been a lot of talk recently from many analysts that suggest if the market is going to rip higher, small caps are going to lead the way because investors are looking at stocks that have been beaten down a little bit. And that means right now looking at the small cap sector.
Yeah, with that also probably means some risk too. If you're looking at those beaten down names, you're basically having to hope or really believe in that turnaround coming, that there is going to be a boost in the market. Small caps might be the first to be hit, but talk about the risk first before we move on.
I was looking for stocks that were trading at a low price to earnings ratio. And by low, I'm defining as a price to earnings ratio somewhere between that area of 5 times and 12 times. The average PE right now for the S&P 500, the last time I checked it a couple of days ago was probably around 21, 22 times. So if you're seeing a stock that's down at 5 times to 12 times earnings, that's trading at a significant value to the S&P. Now, to your point about the risk is many times when you see a stock that's trading that much of a discount to the S&P 500, it's because there's some fundamental problem with the company. That's not the case, at least from what I saw, with the companies on the list.
All right, well, let's dive right into this list today. I know we are looking at 3 names, all small caps that are all at that discount that you're talking about. What is the first company on the list today?
So the first company, we're going into the biotech sector, which is going to be something you're going to see a lot among small cap stocks. The company's name is Innoviva. Ticker symbol is INVA. As we are talking right now, company has a price to earnings ratio of around 7 times earnings, 7.8, I believe is to be more accurate. What makes this company interesting is they have a business model that allows them to generate considerable revenue, even though they don't have a product in market yet. They partnered with GlaxoSmithKline to bring some respiratory treatments to market. And as part of that partnership, Innoviva collects royalties off of those drugs that are sold by GlaxoSmithKline. The royalties they make off of those drugs helps to fund the rest of their pipeline program. And they do have some specialty therapeutics in the pipeline dealing with critical care and infectious diseases. The idea for investors is one of the risks with a lot of biotechs, especially these small ones, is that there's going to be dilution as they have to raise capital to get their products to market. That doesn't seem to be the case with Innoviva, and the earnings story seems to bear that out.
Yeah, let's look at the earnings because it does look like they've had a lot of success recently.
The thing that stood out to me when I looked at them was, first of all, this is a profitable company. They're growing their earnings very strongly. They had, at least last year, very strong year-over-year growth, not only in revenue, but in earnings. And the projection is that they're going to have over 360% earnings growth this year. And that doesn't seem to be factored into the stock at all, even though the stock's already up almost 20% this year. It seems like the stock has further to go. Analysts seem to agree. The consensus price target on the stock is $34.80 as we're taping this, and that's an upside of over 45%.
Yeah, that's some decent upside on a stock like this. I
Right.
do wanna talk about anytime this is the only biotech on the list, these aren't all
Right.
3 biotech companies, but anytime we talk about biotech, I also wanna talk about the risks specifically associated with biotech and small cap biotech stocks. We're seeing a lot of, strong earnings growth right now and a lot of anticipation for more growth in the future, but there's always a risk with these biotech stocks. So talk about some of that risk that you should keep in mind as an investor when you're looking at these kinds of stocks.
Anytime you're dealing with a biotech company, a company that's in this clinical stage, is the risk that the drugs that they're trying to move through their pipeline aren't going to get approved, which means there's gonna be a delay in that revenue base. That doesn't appear to be the case with Innoviva, and one way that investors can notice that is that right now, their dependence on royalty income is shrinking. It was about 72% of their revenue. Now it's about 60%. So that means there's optimism that they're going to start being able to stand on their own with their own commercially available drugs. And that means that the revenue becomes that the royalty revenue even just becomes kind of icing on the cake for them.
Definitely some good signs for this company. And with these biotech companies, you never know which drug might take it from a small cap biotech to a really large company, like some of those more popular names that we've seen in the market. But some of the big biotech names are actually down right now and also kind of trading at a discount. So if you're more into those large cap stocks and bigger names, check out this article at marketbeat.com right now. It's 5 baby boomer stock favorites that are now trading at a discount. You can scan the QR code or click the link in the description to get that article and 5 other big stocks on marketbeat.com right now. All right, Chris, let's move on to this list. And the second stock on the list, no longer talking about biotech, but this is a small cap stock that's also trading at a considerable discount when you look at price to earnings.
Yeah, we're talking about Neighbors Industries. Ticker symbol here is NBR. This company's in the oil and gas drilling sector. And to be honest, just knowing that it was in the oil and gas drilling sector, it surprised me that you found a stock that was this low of a PE. But as we're taping this, it's got a PE of around 5. So that means this is an exceptionally very well valued stock for being in the sector that it's in.
Well, we have a lot to dive into it as far as what's happening in the oil and gas sector, but I want to look at the earnings first because it really popped out on this stock. When you look at
It
some of
did.
the data on this company, they had a huge earnings beat back in February. What's behind those numbers?
You know, that's a really great point, Bridget. It's a good place to start here because if you're an investor that maybe you haven't looked at Neighbors before and you're looking at it now, you might be thinking that everything that you're seeing with earnings happened because of what's going on in Iran, but that's really not the case. Neighbors reported earnings towards the end of February, and that was their fourth quarter and full year earnings. And you're right, they had a huge beat on your adjusted EPS. But a big reason for that was because of an acquisition they made, plus another step that they took to reduce some debt on their balance sheet, and that's helped the number be much better, than what analysts were expecting. On the revenue side, they had a beat, but it was kind of just, it was a meh. It was a beat, but it wasn't that impressive. Initially, after the earnings report, the stock actually dipped a little bit. But then what happened a couple weeks later was the conflict with Iran started, that goosed oil prices, and Neighbors rose right along with it.
And this one has been rising quite a lot, like all of the oil related stocks have been. It's actually soaring above what those analyst price targets are, too. So let's talk about that a little bit. Is it difficult to look at a small cap stock like this that may have that price to earnings ratio at a discount, but it's still soaring so much because of everything that's going on? What's the risk associated with that? What are your thoughts on investing in any kind of oil related stock right now, given the conflict and geopolitical issues still at risk right now?
Right. So the risk and reward for Neighbors is, I believe it's similar to what you're dealing with any stock that has to do with oil and gas right now. And that is the belief among many analysts that oil prices could move down just as sharply as they moved higher if there's a quick, and quick is a relative term, resolution to the Iran conflict, particularly as it relates to the Strait of Hormuz, and we get free flowing oil moving through the strait. Now, having said that, my personal belief is, and I've been talking about this for probably a year, is that I felt that oil was undervalued because I felt that demand was going to increase. Nothing to do with geopolitical causes. I believe that it just has to do with if we're going to be building out the kind of infrastructure that we want to build out in the US, and I'm not just talking data centers, and you take that and you extrapolate that globally, there's going to be a demand for energy. The world just needs more energy. And right now, fossil fuels is where they're going to get it. I just think that's a tailwind for oil. Does that mean oil is going to be, up around 125, 150? I certainly hope not. And that's not going to be good for the global economy. But I certainly could see a world where we're still seeing oil at elevated levels for a significantly longer period of time, which would be bullish for a company like Neighbors.
I want to talk about Neighbors in particular and what area of the oil industry they're in. What sets them apart fundamentally from some of the other oil stocks out there? I know they have been getting, even though it's soaring above those analyst estimates right
Right.
now, it does seem like there's recent analyst price targets that are pretty bullish on the future of this company. Why is that?
This company is in the drilling services business. So they're going to be the company that oil drillers go to when they're looking to start increasing production or start to look for new wells or do those sorts of things. And that's what's happening right now is that business accelerates when the price of oil makes it cost efficient to do so. You're seeing the same thing happening in the mining and metal space where it's becoming more profitable for gold miners and silver miners because the price of the precious metals price is so high. It's the same thing going on in the oil patch, and that's why a company like Neighbors has been doing so well, and it's why analysts are raising their price targets.
Yeah, before we move on, let's talk about those recent price targets because again, we're trading above consensus right now. But how bullish are some analysts on the future of this oil company that's already had such a big increase in recent months?
As we're taping this, the consensus price target for Neighbors is $71.38, which is about 14% below where the stock's trading at. But just in April, we've already seen Citigroup and Susquehanna increase their price targets for Neighbors above where the consensus is. And in both cases, it's above where the stock is currently trading. Although in the case of Susquehanna, they're looking at a price target of 85. Neighbors is trading right now at 83 and change. Citigroup's got a higher price target of 89. I think some of that may change once we hear from the company's next earnings report.
Right. And that's another important point with this one. The earnings report is still coming up just a couple weeks away. They may
Yeah.
have just had one in February, but their next earnings is really coming up. And will that include some of the impact we might be seeing from the increased price of oil and things like that?
I think you will, and I think that's a really critical point for investors right now is it doesn't matter what I think, it doesn't matter what other analysts think about oil. What really matters is what you're going to be hearing from a company like Neighbors when they report. And that report's coming up on April 29th, according to their website. You're going to hear right from the company, and they're going to have a lot better line of sight as far as what they're expecting for revenue and earnings going forward. And that's when you could see these price targets go much higher. Conversely, it's also when you could start seeing price targets retract. So it's kind of a binary bet. But right now, if you're not in Neighbors already, you might just want to have this one on your watch list.
Now, speaking of watch list, I'm trying to decide which one of these three stocks we're talking about today to add to my Bridget Spies watch list. This is my paper trading watch list
Right.
where I add one stock every video we talk about so that we can follow how the stock moves over time. You can scan the QR code or just go to marketbeat.com/Bridget to take a look at this watch list. I've started it back in November and have been adding stock after stock. And some of these, we talk about a lot of small caps. So there's a lot of small cap names on the watch list. And so I'm hesitant to add the biotech because I know there's so much volatility there. Although that name is very interesting to me, I'm hesitant to add oil and gas because there's so much volatility happening in that sector. So I think I'm going to add this last stock you have on the list to my watch list simply because it's a very familiar name that I think would be fun to follow over time. But I'm really curious what your case is for this company. So let's get into stock number 3, Chris.
Yeah. Okay. So the last stock on my list is Wendy's. This is a company that, as we are taping this right now, it's trading at a price to earnings of around 8.3, and the forward price to earnings is only 7.1. So again, deeply discounted stock. And I understand that many people that are watching this video will immediately say it's cheap for a reason, and it's due to the fact that the company is not doing well fundamentally. And that is true to a certain extent. Not going to sugarcoat it. The last earnings report was bad. There's a same store sales decline, which you never like to hear when you're dealing with retail stocks or restaurant stocks. It's real, it's concerning, it's been talked about ad nauseum, we don't need to talk about it anymore. There's pressure on the consumer, especially in that lower leg of the K. They're pulling back on dining out. There's also concerns about what is the impact of GLP-1 drugs on fast food demand. Having said all of that, it does appear to me that Wendy's is presenting an area where the stock may be just so bad it's finally good. What I look at, what I take away from the earnings report is management's controlling what they can control. They're closing underperforming locations. International growth has been okay with the company. A lot of this is just going to have to do with what happens when there is a recovery with the consumer. I don't see Wendy's as a company that's in danger of, going out of business and like all the stores are going to have to close. I don't see that. I think it's a demand story. I think it's they're kind of in that situation of you're trying to play in an arena where consumers have a lot of choices and you're trying to compete on price, and that's never a winning strategy, but that's the game they got to play right now. What may keep you interested as an investor is the dividend. There's some caveats around the dividend, but I think that might be the way to go.
Yeah, the dividend is one positive when you look through the different pages of stats for
Yeah.
Wendy's, but a lot of it is very ugly, like you said, and I'm glad you started out with that. The chart is very difficult to look at right now with how much of a decline it's had. There is one other encouraging spot, and that is that there are some analysts who do still see at least some kind of upside for this stock, although the price target action and revisions hasn't been great news for this company either. Just trying to look at what other catalyst it could take to really bring that upside for this company and turn that chart around, because it's just been a falling knife, I think, for a lot of investors who have been looking at this and following
Yeah.
it go down and down and down again.
Right.
I love the analogy you gave of it's so bad, it might finally be good.
Right.
Is that a real thing?
It can be. It's one of those things among investors, especially when you deal with a stock like Wendy's, where selling begets selling. And once a stock starts to drop, you refer to it as the falling knife. It just keeps falling because once people start selling it, nobody wants to be the first one to jump back into it. So it's easier just to say, we're just going to let the stock go down. And when the company has an earnings report like what it did, that doesn't help matters because, again, the revenue was down. However, on the other hand, you did see a slight earnings beat. And again, I think that just goes to what I said about the companies controlling the controllables. Again, let's go back to the dividend. As we're taping this, it's got a dividend yield of around 7.9%. Now, I'm going to be honest, a lot of that's because the stock price was down so much. It wasn't because the company raised the payout of the dividend. They haven't. However, I would say that yield has actually gone down just a tick in about the last week because the stock price has gone up a little bit. Right now, analysts are projecting that Wendy's could grow earnings by about 13% this year. That's not bad when you consider that a lot of restaurant stocks, you're going to be lucky to see low single-digit earning growth, and they're projecting Wendy's might get 13%. So there might be some upside here, and in the meantime, you're getting a dividend with a nice yield of about around 8% that looks safe for now.
And whether you're interested in Wendy's or not really kind of depends on what you think about catching that falling knife or not. If you want to hear a different perspective on what to do with these falling knife kind of stocks, make sure to watch the video we just posted yesterday with another YouTuber, Joseph Hogue and the Bowtie Nation. See what he has to say about what to do with those falling knife stocks. You can watch that video here.